The Dow closed at a record high Thursday, while the 30-year mortgage rate hit its highest level since August 2025. Those two facts cannot coexist in a normal rate environment, and understanding why they do defines what the market is actually pricing. Iran's demand for tolls on Strait of Hormuz shipping, confirmed by U.S. negotiators this week, converted what traders had treated as a ceasefire track story into a supply restriction scenario. The Hormuz Strait handles roughly 20% of global oil flow. A toll regime is not a blockade, but it introduces a persistent cost floor into crude pricing that does not resolve with a ceasefire agreement. That distinction is what moved the bond market. The G7 sovereign debt complex, a $50 trillion safe haven pool, saw institutional demand for inflation protection accelerate. Foreign central bank net selling of U.S. Treasuries, already elevated in April, extended into May as war-linked inflation expectations reset. The 10-year yield's move toward 2010 highs was not driven by growth optimism. It was driven by duration holders demanding a war premium that the Fed has not yet validated through policy. The transmission to mortgage rates is mechanical. The 30-year fixed rate tracks the 10-year Treasury yield with a spread. When bond vigilantes push the 10-year up, mortgage rates follow within days. At 6.51%, the 30-year fixed is at its highest in 9 months, not because the housing market overheated, but because the cost of duration risk is being repriced by war. Nvidia posted 85% revenue growth in Q1, and the Dow closed at a record. Those signals would normally pull capital into equities and compress risk premiums. That they did not compress the bond spread reveals that the inflation pricing is not a reaction to a one-session news event. It is a structural repricing of what war in the Middle East costs a bond portfolio over 12 months. The question that repricing leaves open is whether the Fed will validate the market's rate hike pricing, or whether the bond move is running ahead of policy reality.
The bond market's demand-supply imbalance just acquired a second leg that has nothing to do with Iran. SpaceX is filing for a $75 billion IPO, potentially the largest public offering in U.S. history, introduces a discrete liquidity event into a market that is already absorbing war premium repricing of treasuries. The mechanism runs through the IPO allocation pipeline, a $75 billion offering at a $1.5 to $2 trillion valuation requires institutional underwriters to pre-position significant capital that, in the current environment, comes from rebalancing existing bond and mixed asset holdings. South China Morning Post reported that the filing itself has already lifted Fed rate hike probability in the derivatives market, not because SpaceX affects monetary policy directly, but because the IPO scale signals that institutional investors will need to liquidate duration positions to fund equity allocations. The SpaceX filing also disclosed that Anthropic pays $41 million per day for AI compute, a figure that, placed alongside Nvidia's $75 billion quarterly data center revenue, tells institutions that AI infrastructure spending is compounding faster than consensus models assumed. That signals to bondholders that inflationary capital expenditure in the AI sector is not peaking, it is accelerating. Investors who priced AI spending as a 2024-2025 phenomenon are now repricing the duration of that spend into a 2026-2028 horizon. The combined effect, war inflation premium in treasuries plus IPO supply demand from SpaceX, positions the bond market for sustained yield elevation even if Iran negotiations produce a temporary ceasefire. A ceasefire removes one leg of the premium, it does not remove the structural demand created by equity IPO supply. That asymmetry is what the yield curve is pricing today, and it is why the 10-year has not corrected on ceasefire headline optimism. The unanswered variable is whether the Fed's signaling. Fed Governor Barkin stated this week that rate hikes may not be the appropriate response to war-driven inflation, holds against the market's own rate hike positioning.
If bond duration is being sold and AI mega-cap equity is stalled by guidance disappointment, the intra-equity rotation has to land somewhere. On Thursday, it landed in quantum computing stocks, and the magnitude of the move reveals how much pre-positioned capital was waiting for a government catalyst. The U.S. Commerce Department announced $2 billion in quantum computing incentives across 9 companies under the CHIPS Act, with IBM, IonQ, D-Wave, and Rigetti among the named recipients. IBM gained 12% in a single session. RGTI surged 30%. QBTS rose 33%. The moves were not driven by fundamental earnings revisions. These companies have no near-term quantum revenue that justifies one-day 30% moves. The move is institutional rotation into a government backstop sector. at a moment when rate-sensitive tech and bond duration are both under pressure. The positioning logic is specific. Quantum computing stocks carry near zero duration risk in the traditional sense. They are pre-revenue, and their valuation is anchored to government contract pipelines rather than discount rate-sensitive cash flows. In a rising yield environment where long-duration tech faces multiple compression, a government-funded pre-revenue sector offers equity exposure without the bond yield headwind. That is not a fundamental argument for quantum computing. It is a flow argument about what institutional capital buys when its usual duration proxies become expensive. Rigetti signed a letter of intent for U.S. government quantum research the same day. The signal that a government mandate is materializing, not just a funding announcement, but an active procurement signal, converted what had been retail speculation in quantum names into an institutional entry point. The checkoff variable here is whether the Commerce Department's $2 billion translates into awarded contracts within the next 60 days. If contracts are awarded on schedule, the quantum rotation deepens. If the announcement proves to be a letter of intent phase without near-term conversion, the 30% single-day premiums will unwind against a bond market that still has not resolved whether it is pricing war inflation, AI supply pressure, or Federal Reserve policy, all three simultaneously with none of them settled. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.